I now have the privilege of introducing to this audience a gentleman who really needs no introduction, Mr. Deepak Parekh, the chairman of Hdfc Limited. He joined this company in 1978 and became its chairman in 1993. Mr. Parikh's astute business acumen and farsightedness has transformed the group into India's leading financial services conglomerate with presence in mortgages, banking, asset management, life insurance, general insurance, real estate venture fund, education, and education loans. He is on the board of several leading Indian and international corporations and advisory boards across diverse sectors. Mr. Parikh is the recipient of several awards and honors. The Government of India honored Mr. Parikh with the Padma Bhushan in 2006. In 2010, he was the first international recipient of the Outstanding Achievement Award by the Institute of Chartered Accountants of England and Wales. In the same year, he was also awarded the Knight in the Order of the Légion d'Honneur by the French Republic. In 2014, he was awarded Germany's Cross of the Order of Merit, and in 2017, the Mayor of London named Mr. Parikh as the first of a network of international ambassadors for championing London across the globe. Mr. Parikh is known for his vociferous views seeking standardization and transparency in the real estate sector. He has always been willing to share his ideas and experiences and is a sought-after member of various high-powered committees to reform policies across sectors. A man with a mission, Mr. Parikh's philosophy on corporate social responsibility is simple yet profound. He believes that if a company earns, it must also return to society, and that companies owe a responsibility not just to their shareholders, but to all their stakeholders. Ladies and gentlemen, I present to you a truly distinguished speaker for this evening, Mr. Deepak Parekh.
Lakshmi Narayanan, Meenakshi Ramesh, ladies and gentlemen, good evening. Much as I would have liked to be in Chennai today, meeting virtually is our new reality. Adapting to an ever-changing new normal is what we all have to learn to cope with. A huge milestone is that today, globally, more people have been vaccinated than those infected by COVID-19. The global outlook is akin to a glass half full or half empty. Optimists see vaccines, pessimists see mutating viruses. At this juncture, no one knows who is right. Personally, I have always been an optimist. I am optimistic to believe that I will visit Chennai soon after a jab and look forward to having authentic masala dosa and some strong South Indian filter coffee. United Way Chennai is a pre-teen now. At 11 years old, it has established a credible track record owing to its focused approach on healthcare, education, vocational training, and particularly its work on the Anganwadi Development Program and children with disabilities. We at Hdfc and through the H.T. Parekh Foundation are privileged to have partnered with United Way Chennai. We recognize United Way Chennai is indeed making inroads in changing the way its neighboring communities live, earn, and grow. India has done well to have mandated compulsory CSR spend in 2014. I do believe companies have a moral obligation and they need to play their part in helping build better, stronger, and sustainable societies. The CSR spend is one way of sensitizing organizations and employees of the importance of creating caring societies. A comply or explained regime should have worked well. Unfortunately, few instances of misuse of CSR funds and ingenious ways of rerouting CSR funds back to the company or to the promoter has resulted in stricter and more onerous norms for all companies, as seen in the recent CSR amendments. This is one more reminder how important collective good corporate behavior is. On the other hand, due recognition must be given to corporate India and thousands of NGOs and volunteers for all their assistance during India's darkest moments, especially in the early days of the pandemic. Changing gears, let me now shift to sharing my thoughts on the Indian economy. Since the eruption of the pandemic, GDP forecasts are akin to shooting darts in the dark. Soon into the lockdown in March 2020, most were in complete denial that India could ever witness a negative growth. We knew our GDP was trending downwards, but a recession was never contemplated. Since independence, India had a recession only 4 times: in 1958, in 1966, in 1973, and 1980. But these were as a result of either an agriculture crisis due to weak monsoons or an energy-related crisis, as we are a major oil importing country. Initially, when India's first GDP recorded a contraction of 23.9%, it was a shocker for the system. The reality was there was nothing surprising, as during that time, India was under strict lockdown. But the sentiment was such that economic growth forecasts swung to a total doomsday scenario. As the economy gradually started opening up, the pace of recovery surpassed most expectations. Every high-frequency indicator was being tracked very closely and surprised on the upside, be it Google Mobility Index, e-tolls, e-way bills, GST collections, digital transactions, car and two-wheeler sales, electricity consumption, among several others. So from September 2020 onwards, one could confidently see India's resilience and revival of growth. The recovery wasn't just pent-up demand. It reflected inherent structural demand. As we stand today, we are likely to end this financial year with a GDP of negative 7.5%. Now, this is owing to 2 consecutive quarters of negative growth. This trend has already reversed, and in financial year 22, which will start in April, but it will start with a lower base, India is likely to be in the range, the GDP growth rate in India is likely to be in the growth range of 10.5% to 11%, assuming no further setbacks due to the pandemic. This forecast once again places India amongst the fastest growing major economies. Across countries and India stands as no exception, recovery will continue to be patchy and uneven. The pandemic pulled our future forward, especially in terms of adopting more technology. But for many, the scars of the pandemic will linger for much longer. The divide has been severely widened between the rich and the poor, the formal and the informal sector, the permanent and the temporary worker, the stock market versus real economy, or I would say the main street versus the Lal street, jobs that can be done digitally versus those that need physical contact, and governments that have deeper pockets to spend on their healthcare systems and stimulus programs versus governments that do not have access to such vast resources. So the divide has been widened, has been much more now. The next question is, What are the right set of policies and frameworks needed for a more even-paced recovery? So far, the Reserve Bank has done its bit, and Reserve Bank has done most of the heavy lifting in terms of ensuring the markets have adequate liquidity, in terms of ensuring interest rates are kept low as possible, as low as possible, and necessary regulatory forbearances are granted to ensure revival of the real sector activities. The recently announced budget, too, surprised on the upside. Unusual times call for unusual measures, and this is what the budget delivered. Now, what triggered the budget euphoria? Clearly, this budget bets on growth, and it bets big on growth. It is a borrow and spend budget to get growth back on track. Capital expenditure in the new year, starting from April, financial year 2022, is estimated to be an all-time high of 5.5 lakh crores, which is 35% increase over the previous year. This will get deployed in number of areas like highways, metros, ports, housing, railways, and other projects in the national infrastructure pipeline. So basically what I'm trying to say is, when India builds, India grows. When India builds, India creates jobs. When India builds, India creates opportunities for several other industries with backward and forward linkages to construction activities. The budget rightly focuses on a construction-led recovery. There is a dramatic shift from budgeting for a traditional fiscal deficit of under 3.5% of GDP to focusing on growth, focusing on job creation, and triggering multiplier effects on various sectors of the economy. The path to fiscal prudence will be reverted, but only after the Indian economy has stabilized. This was a bold move. This was the right approach to follow. The other reason attributed to the euphoria is what the budget did not do. It did not raise taxes. It did not increase cess. It did not bring in COVID cess. It did not raise capital gains tax or bring in wealth or estate tax. Indeed, the budget opted to raise more non-tax revenues through a combination of divestment, asset monetization, and privatization. These announcements were bold and creates an opportunity to once again fast-track India's financial sector reform agenda. Yet, this strategy will need a lot of deft handling. There is now a national monetization pipeline created. Assets like roads, freight corridors, and gas pipelines would be put up for sale either as an InvIT or leased to private players. There is a ready pipeline of companies for disinvestment, such as Bharat Petroleum, Concor, BEML, Shipping Corporation, Air India, amongst others. Yes, divestments and disinvestments have missed their target in the past. But one does believe that there would be no better time than now to capitalize on a buoyant stock market. The government too has articulated that it needs to be invested in only select strategic sectors. The IPO of LIC, take for instance the IPO of LIC, should have seen some fruition last year, but little progress was made on that front. The kind of valuation that LIC can extract is humongous. At an estimated valuation of anywhere between 9 to 11 lakh crore, a 10% dilution could garner the government over 1 lakh crore. My personal view is that the government cannot afford to slack on non-tax revenue generation. So they will need to get serious on fast-tracking disinvestments this year. The finance minister also mentioned monetizing surplus lands of state-owned enterprises to make prime commercial properties available for development, create new business districts, and unblock the hidden value of its land holdings. If there is one government that stands a strong chance of pushing through the legislative amendments needed for large-scale privatization or monetization, undoubtedly it is this government, given its present strong majority. Yet, we are in a noisy democracy, and consensus on critical issues and reforms is very important. Another big-ticket proposal was setting up of a well-capitalized DFI, Development Finance Institution, with an initial capital of 20,000 crores. What we need in India is patient, long-term capital, particularly for infrastructure financing. We need institutions with deep pockets, like sovereign wealth funds and pension funds, who have long-term investment horizons. Given the fact that globally there is more than $17 trillion of negative yielding bonds, investors all over the world are reaching for investment avenues when they can earn higher returns. India needs to capitalize on this and prove that the country, we as a country, India is an attractive investment destination and can provide higher returns on investments. In India, the DFI of the past found their model unsuitable and they converted to banks. The new DFI must be able to attract top quality talent and maintain high governance standards. Many lessons have been learned now, and we must not make the past mistakes as far as project financing is concerned. Timely execution of infra projects, removing administrative and legal hurdles, single window regulatory clearances, and better monitoring mechanism is perhaps where greater focus is needed. Long-term patient capital is needed, and India needs to assure investors that it will abide by a regime of strong contract enforcement. This is also critically important because contract enforcement has not been as strong as we would like in India. A separate bill will be needed for the DFI. So my surmise is that this may take some time to fructify. The proposal to set up a new asset reconstruction company and asset management company to clean up non-performing loans is also a welcome step. Again, little details are known as of now, but it's a move in the right direction. While the ARC will be a majority public sector owned or private sector, we don't know that. So will the ARC be majority public sector or private sector owned? A sovereign backing will help raise funds for the ARC, but more importantly is that the ARC will need to be run in a professional manner. What we need in India today is more transparent market for valuation of distressed assets and speedier resolutions. Different procedures and rules and regulations, distressed assets take a long, long time to find the right home. We have to condense that time and we have to take speedier resolutions. So it's a good to have another ARC, but it is better to focus on speedy resolutions of stressed assets because the problem of bad loans don't go away just by shifting the loans from one balance sheet to another balance sheet. Specifically on bank privatization, it'll be interesting to see the government will finally bite the bullet. While the budget has announced 2 PSU banks would be privatized, it is uncertain if this means the government shareholding will be less than the 51% or whether the government will opt to fully exit the shareholding in these two banks. We have to wait and see. Either way, it is a right move. It's a move in the right direction. If the government chooses to offload a larger PSU, it stands a better chance of garnering larger resources, which in turn could be deployed in other critical sectors of the economy. Valuations will always be tricky, since most PSUs trade at a significant discount to their book value. With markets at all-time high, and this being a particularly unusual year for India, the opportunity to capitalize on radical reform should not be lost. In sum, it was a budget that got its immediate priorities right and kept the positive sentiment going. Speedy implementation now remains key. Execution and implementation has always been our weaknesses. We hope that we overturn this for the current year and see progress on execution and implementation. While India has many challenges, it is equally important to recognize the opportunities the country has. We have an advantage of being at the forefront of vaccine manufacturing, coupled with low fatality rates and declining number of infections. May the worst be behind us. Take, for instance, our forex reserves. Our foreign exchange reserves today stand at an all-time high of $590 billion. This is more than the India's overall external debt, which stands at $554 billion. And don't forget, India's debt is soft loans from multilateral agencies with 30-year repayment periods, like the IDA loan of the World Bank or the KfW loan or the JBIC loan. So on the external front, we are extremely strong. The scope to grow in India remains immense. Indians are inherently aspirational and resilient. We are a consumption and services-driven economy, and we need to play on these strengths. Financial penetration, be it in consumer credit, be it in mortgages, insurance penetration, is so low compared to any other comparable country that there remains immense scope to deepen and grow these markets. India needs to singularly focus on ensuring that our youth have opportunities to be gainfully employed. On a complete wishful thinking, what India needs is a job machine which can create millions of jobs each year. If we don't harvest the energies of our youth, India stands to lose a generation, something that we cannot afford, something that the country cannot ill afford to do. It has been a pleasure sharing my thoughts with you, and hopefully next time we all get to meet in person. Thank you.